I'm Emily Chang, and this is Bloomberg Technology. Coming up, after a killer year for tech stocks, will the sector become a victim of its own success? Plus, links to cryptocurrency are fueling record gains of little-known fintech companies. We'll discuss. And Amazon could outdo its own monster year. Why America's e-commerce king could be on track to becoming the first U.S. retailer to sell $1 trillion worth of products and services. First, to our lead. U.S. stocks finished with the tech-heavy NASDAQ having its worst day in more than 2 weeks, even as tax reform is pending in Congress. At one point, Apple was one of the biggest point drags on all three of the major averages. Bloomberg News stocks reporter Abigail Doolittle joins us now from New York. So, Abigail, what's happening with Apple today?
Well, it was a pretty big move. It really stood out, Emily. Apple down more than 1% on the day on a rare downgrade. Nomura downgraded the shares to neutral from buy. The analyst there citing the fact that all of the good news is already priced in. And he makes an interesting point, considering the stock is up about 50% on the year. He's making the point around the iPhone super cycle. And something else that stands out here around these gains, if we hop into the Bloomberg and take a look at #BTV7997, there's a pattern that emerges around the quote-unquote super cycles. Back around the first iPhone, we see that shares rallied and then sold off. Something similar in 2012 and then 2015. We certainly see the rally on the iPhone 10 super cycle expectations. But the interesting thing here, Emily, is relative to growth. Fiscal year 2018 for Apple, which ends in the September quarter, is about 20%. That's a tremendous growth rate thanks to that iPhone 10. But for fiscal year 19, it's expected to drop down to about 2%. That's really a pretty incredible drop off in growth. We've seen those sorts of drop offs in growth over those last super cycles once they wean away. And really interesting, Emily, if you can believe this, it's not an apple-to-apple comparison, and no pun intended there, for the fiscal year 19 and 20 for Walmart. But Walmart is actually right now modeled to grow slightly more than Apple over the comparable time period, if you can believe it. So that might be something that the street is starting to look ahead to as well.
I like the puns, Abigail. Bring it on. What about some of the other big tech names? You know, we also saw a drag there. Did that have to do with what we were seeing with Apple, or what's happening or not happening with tax reform?
Probably a little bit of both, so Apple, that risk-off tone, especially a downgrade, perhaps investors wondering if that's a sign of what's to come for some of the other big tech names. We certainly had those FANG names selling off on the day: Facebook, Amazon, Netflix, and Alphabet. There didn't appear to be a specific spark, so it could have been that. Plus, there is the idea that all these technology companies already have very low tax rates, so less likely to benefit. That could be another small piece of it. Unclear there, but certainly a bit of a risk-off tone for some of these high beta names. We also had Tesla trading lower on the day. Now, very interesting, UPS said that they have commissioned the company for 125 of those electric vehicle trucks. One thought there could be the idea that production for this company has had its issues, as you know, Emily. So maybe investors thinking that's a high bar for the company, even though it's also positive. But interesting, relative to taxes, while there doesn't appear to be an electric vehicle tax credit ding in the current tax overhaul, the fact that it has come up that it should be limited to 200,000 vehicles, the tax credit, that could be something that investors are thinking about for the future for sure. So tax reform, tax overhaul, Emily, certainly a big influence on the markets today.
All right. Bloomberg's Abigail Doolittle for us there in New York. Abigail, thank you for the rundown. Meantime, the euphoria around tech stocks we've seen in 2017 may evaporate by next year. According to a survey of fund managers by Bank of America, the FANG trade is getting a bit crowded. Michael Wolff, CEO and co-founder of Activate, here with me as my guest host for the hour. So what's your outlook for tech in 2018? Can it compare to 2017?
I think we're going to continue to see massive growth in the underlying revenue and earnings of these companies. And if you look at them, each of them from from a market perspective, has been way up in this year. I mean, the largest companies, 50%. And of course, investors are concerned. The tech companies, the FANG companies together account for, they're way overweight. Together, they're about 10% of the S&P 500. All tech is around 20+% of the S&P 500. So at some point, we are going to see investors slowing down their investment in these companies.
It feels like, though, we ask that every year, and every year tech keeps getting higher and higher.
Well, part of it is that you're dealing with companies that are so dominant in these businesses. So if you look at between Google and Facebook, they totally dominate all digital advertising. There's 75% of digital advertising. If you look at Apple, we can look at all the super cycles from Apple, but the reality is Apple delivers the highest priced phones and the entire ecosystem around it. So in a lot of ways, these companies are unassailable. Their growth is going to continue.
So what are the headwinds? I mean, we saw what happened with Apple and Nomura earlier today. You know, where do you see weakness?
I think the biggest weakness is going to be as these companies are moving into international markets, they're facing some very, very tough competition. So if you look at Alibaba, JD.com, Tencent, these companies are not just staying at home. They're moving beyond. I think we're going to see a lot more of the penetration of Android phones. So in each one of these companies, and of course there's a big backlash against Facebook and Instagram at this point. So somebody else will come out with a service that drives consumers. So do I think these are near-term trends? No, but I think it's going to affect them longer term.
Where do you think the battle lines will be drawn abroad? I mean, what countries or what markets do you see these companies clashing with Chinese tech companies?
Well, I think they're going to, certainly in Asia, but the Chinese tech companies are going to be moving here. Mm-hmm. And at the same time, we're going to have a lot more regulation in Europe that's going to dampen the growth of any of the major tech companies. So it's, again, there's nothing imminent, mm-hmm. but over time, also the law of large numbers just overtakes you.
Right. Our producer, Aaron Dresch, said that the worst thing that tech has going for it is how well they did this year. So, you know, my question is then, you know, if none of these things are near term or immediate, then what happens, let's say, in the first half of 2018?
I think they're going to continue to grow. I think we're going to see tremendous growth from each of these companies. And part of it is that the underlying forces are there. It's the shift to e-commerce. It's the shift of advertising and the growth in digital. Everything that's going on in these across the industry is really, it's a rising tide that's going to float all of these big company ships.
All right, Michael Wolf of Activate, you are with me for the hour.
Great to be here.
Great to have you back. All right, Facebook has introduced new features to curb abuse and protect privacy on the platform. New facial recognition features should help prevent unwanted contact, like friend requests and messages when someone you blocked sets up a new account or tries to contact you from another account that they control. The new features also provide the option to ignore a messenger conversation and automatically move it out of your inbox without having to block the sender. Coming up, what is the formula for a 2,700% rally? The combination of fintech and cryptocurrency, why fintech companies like Digital Power are pushing into the crypto space. That's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. A marriage of fintech and cryptocurrency is fueling serious gain. Just look at Longfin, for example. Shares have skyrocketed more than 1,000% since the fintech firm went public just last week. And what sparked the gains? Announcing a move into the digital currency space. Its market cap swelled to more than $7 billion at one point. However, after an interview on CNBC, shares began to reverse direction, falling 14% in post-market trading on Monday. Here with us, our Bloomberg editor-at-large, Corey Johnson. So, watch this interview on CNBC. It was
special.
Fascinating.
Welcome to
what happened?
Okay, so from the day you and I first met, I would tell you about these stocks that I used to be involved with. When I used to be a money manager, and I would look for these companies that had specious business models or non-existent business models, but had robust stocks that seemed to tie into a trend. I've seen this movie before. All right, we've seen lots of these reverse merge companies or shells of companies that come with a new name for a business plan or throw out some buzzwords and suddenly see their stocks fly. But we're seeing that right now with Bitcoin, and that the difficulties of getting into the Bitcoin market or people trying to capture the next greatest thing are just running after any stock they can get at. There also may be stock promoters at work here who will illegally, this happens time and time again, it's illegal, but will start a stock running, get a stock on the move, hold their shares back, maybe buy and sell between known parties. Again, it's illegal, but we've seen Wolf of Wall Street. We saw this constantly in days of yore, where these stocks just start running and continue to run.
So they go public. 2 days later, they announce they're buying a blockchain company. The stock soars. What makes this company worth even $1 billion?
It's a greater fool theory, right? If some moron thinks this is going to do well, they think that they can buy it.
It still closed today at $5.8 billion. And
I think what we see is, and they're not alone. In fact, we've got a whole bunch of these companies that have gone, that have rebranded themselves or somehow gotten a new set of attention. A Chinese energy company, now it's going to call itself a blockchain company. Look at the valuations on some of these businesses. Long Fitness, $5.8 billion. UBI blockchain, $2.3 billion. I looked up the company's headquarters in the U.S. Is a Regis office suite, like a temporary office space rental in Park Avenue. I called the number for the U.S. headquarters. Some guy picked up on his cell phone. It's got a $3 billion valuation. I mean, this is where we're at right now with people bidding on these assets without being able to understand their ultimate value.
If I was running one of these companies and I got a call from Corey Johnson, I'd be worried.
There's nothing to worry about. I'm a very friendly person. I get along with just about everybody.
So there was another company, the crypto company, where trading has been halted by the SEC. What's happening there?
Concern over who's buying and who's selling here, and that it appears to be something that they want to get regulated on, and they want to see, the SEC wants to know what's going on and who's buying this thing. The concern is not that these guys are doing something illegal, but we've seen things that are illegal in the past that look like this, right? So that the SEC's concern is that if you've got this buyers and sellers with some relationship to each other, that's against the law. We don't know that that's happening here at all. But the SEC, when they see this happen, get involved and put a hold of trading so they can find out exactly who's trading what.
And this is a company that has minted billionaires. Again, not a small company.
Well, they're only billionaires they can sell the shares. Are they selling the shares? They haven't filed, the insiders have not filed to sell shares yet, so we don't know who the sellers are here. And indeed, the volume in a lot of these names I looked at today has come down today from where it was in previous days. We've already seen a lot of value created on paper from these companies that almost all have virtually no business in terms of just revenues and being able to sell anything, let alone an involvement in. But the UTI blockchain, that company has got 18 employees, and it's got a valuation of over $2 billion.
Yet another survey from Yale University about skepticism, concern that we're in a dangerous bubble. What kind of regulation do you think this might prompt?
None. I think particularly with this Congress, that they don't want to get involved in regulating the markets and protecting investors in any way. We've seen some very aggressive efforts to take away protections for investors, and I think we may see more of that. So I don't think that people losing their shirts on this stuff is not going to prompt, I speculate, would not prompt Congress to do anything to create more investor protections.
All right.
I'm not saying it shouldn't, but I'm saying it probably won't.
Keeping us honest, as always, thank you.
Thanks.
Our Bloomberg editor-at-large, Corey Johnson. Well, Elon Musk appears to have just given his phone number to his 16.7 million Twitter followers. In what looks to be a message intended for John Carmack, the co-founder of Oculus, Musk wrote, quote, "Do you have a sec to talk? My cell is..." And then he proceeded to write out the digits. The Tesla CEO quickly deleted the tweet, but this isn't the first time a high-profile figure has accidentally tweeted out what was intended to be a direct private messages. So painful when that happens. Coming up, it is the new battle for better shipping. We catch up with a ShopRunner CEO, how the e-commerce site competes with Amazon for holiday delivery. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Big news for Tesla. United Parcel Service has placed a reservation for 125 Tesla semi-trucks. That's the biggest pre-order yet for the electric hauler planned for 2019. The new trucks will join UPS's existing alternative fuel fleet, which is powered by electricity, natural gas, propane, and other non-traditional fuels. Earlier this year, UPS committed to growing its green fleet as part of its goal to reduce its absolute greenhouse gas emissions 12% by 2025. Well, holiday sales are shaping up to be the best in years. That's according to retail metrics. That's good news for retailers of all stripes, but online spending growth is expected to outpace brick and mortar. And when it comes to e-commerce, free shipping will entice more customers to click the buy button. Bloomberg's Emma Chandra sat down with Sam Yagan, CEO of ShopRunner, multi-retailer alternative to Amazon Prime.
ShopRunner is a membership that allows our millions of members to get great shopping experiences everywhere they shop. Primarily, that's free 2-day shipping, free returns, and seamless checkout. For the retailers in our network, it gives these retailers a chance to aggregate their scale to better compete in the marketplace.
And so what we're really looking at here from the consumer side of things, though, is this shipping experience or a better shipping experience. How do you convince them that they can get that by paying a membership fee?
Well, thankfully, Amazon Prime has really sort of set that precedent for us. In fact, we were founded on the premise of this, ShopRunner would be just like Amazon Prime for everyone else. And so Amazon Prime has, millions of people paying $99 a year. Our price is $79 a year, and we have partnerships with people like American Express, where cardholders can get a membership for free.
Now, also things like Amazon Prime offer a number of other benefits as well that come with that membership, which might be another reason why people are willing to pay it. Are you concerned at all that you won't reach the kind of figures that Amazon will because you're not offering anything else?
Well, I'm not really worried about being compared to Amazon right now. I'm really happy. We're focused on making the e-commerce experience as strong as possible. We have 140 retailers in our network, and that's really what they want us to do. They want us to help them have a best-in-class, frictionless e-commerce experience, and that's what we're laser focused on.
Now, what's interesting to me is that a number of the retailers that are within your platform or operate on your platform, they have their own e-commerce sites. What is the advantage of them for them to be a part of ShopRunner?
I think the reason our retailers join the network is to aggregate their scale. So if you think about, the way I think about e-commerce is it's, you have a superpower and in a war against sort of these rebel armies, right? And the question is, how can each one of these armies, each one of these companies alone, hard to fight with someone so big. In aggregate, if you can sort of have a membership that spans a bunch of retailers, then all of a sudden the consumer says, I'm willing to invest in my ShopRunner account. I mean, if you think about it, the biggest friction to most retailers is, what email address did I use to sign up? What's my password? You don't have my current credit cards. You don't have my brother's shipping address. You just don't have your account set up the same way you do with an Amazon. And so because you can use your ShopRunner credentials across 140 retailers, people invest in their ShopRunner account to make their checkout across the network super easy.
Now, Amazon is already doing this. I mean, they're huge. How do you compete with the likes of Amazon?
I think the most important thing we do from a competitive perspective is with our retailers, we make sure that we put their brand first and we are really transparent with the data. The customers belong to our retailers, the data belongs to our retailers, and that allows them to continue to survive and to thrive. And for the consumers, I think the reality is people like diversity. People like shopping in different places. People like to be able to express themselves with brands they care about, with products they care about. And people want to have just a great shopping experience so that they can wear clothes that aren't just from one retailer. And
what are you learning about the consumer? Because you rely quite a lot on big data. You're gathering a huge amount of data about the way people shop. What are you learning from them about how they shop during this crucial time? Yeah, so we see data all across our network. This year we'll have millions of members spending billions of dollars in our network. And so really we're able to track both at the sort of category level, but also at the retailer level, what the trends are. One of the things we saw this year was people
people pulled forward their spending even before holiday week. So November 1st through 20th was much, much stronger than it was last year as retailers brought their promotional calendar forward even before Thanksgiving.
So one of ShopRunner's investors is Alibaba. Yeah. They're an e-commerce behemoth in China. Are they involved in the company at all?
Sure. Alibaba is an investor in the company. They have a seat on the board. And more than anything, we use them to have a global perspective on our business and to really bring the wisdom and expertise they have from operating globally across a whole bunch of businesses to help make us smarter.
That was ShopRunner CEO Sam Yagan with Bloomberg's Emma Chandra. Coming up, Amazon on track for another major milestone for a U.S. retailer. We will dive into Amazon's growth strategy over the next 5 years. And a feature I want to bring to your attention, our interactive TV function. You can find it at TV Go on the Bloomberg. You can watch us live. If you miss an interview, you can go back to it. Send our producers a message. Play along with the charts we show you on air. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg.
I'm Elisa Parenti in Washington, and you're watching Bloomberg Technology. Let's start with a check of your first word news. Republican Majority Leader Kevin McCarthy has confirmed now the House will have to take another vote on the tax bill just hours after the chamber passed the sweeping tax legislation. The Senate parliamentarian determined that provisions in the GOP-crafted bill ran contrary to congressional rules. Spain's Prime Minister Mariano Rajoy has campaigned for his party ahead of a regional election in Catalonia by boasting about his government's crackdown on Catalan separatists. Rajoy dismissed the region's pro-secession government following a declaration of independence in October. Greece's parliament has approved the 2018 state budget today, which does include further austerity measures beyond the official end of the country's third international bailout next summer. The country is struggling to exit an 8-year crisis that has seen its economy shrink and unemployment hit record highs. Oscar Pistorius is appealing his extended prison sentence for the February 2013 murder of his girlfriend, Riva Steenkamp. Last month, the court more than doubled the Olympian's sentence to 13 years. The earliest the double amputee runner will be eligible for parole is 2023. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. It's just after 5:30 p.m. here in Washington, 6:30 now Wednesday morning in Hong Kong. We are joined by Bloomberg's David Ingles with a look at the markets. David, good morning to you. Hope you're off to a good start today.
I wish I had better news, actually. We're looking at a fairly shaky start as we get underway this midweek session in the Asia-Pacific. I mean, New Zealand slightly higher, roughly at the open. But, you know, when you look at across a lot of the bigger markets that are set to open up in about, 30 minutes, of course, in Australia, that market looks to open closer to 1% lower. Now, keep in mind, of course, the close in Sydney on Tuesday was closer to a 10-year high. That's been in a mini run. When you look at Japan, flat to lower start. Just do some simple math. And of course, Hong Kong, there we go, 0.5% futures right now. But the story, make no doubt, today will be in the bond markets after this almost global synchronized move up in bond yields. And at this point, when you look at, of course, the early movers here in the Asia Pacific, Australian 10-year yield, there we go, up 7 basis points, 264 right now on that. Lots of things to watch. We have a rate decision out of Thailand. Of course, the Bank of Japan gets its 2-day meeting underway as well. So lots of things to follow. Again, the bond markets and, of course, the currency markets as well, very much in focus here in the Asia Pacific. And that's an early look at markets Wednesday here. I'm David Ingles. More from Bloomberg Technology next.
I'm Emily Chang, and this is Bloomberg Technology. Amazon hit several milestones in 2017, including its share price hitting over $1,000. The stock is up 54% for the year. The company could be on track to becoming the first U.S. retailer to sell $1 trillion worth of products and services by 2025. This according to the latest report from Bloomberg Intelligence. Joining us now, the analyst who wrote that report, Jitendra Rawal, and still with us, Michael Wolf, CEO of Activate, and my guest host this hour. So, Jitendra, $1 trillion? Why?
So if you look at the end markets that Amazon can realistically target globally, excluding China, the size of that market is about $10.7 trillion today. Against that market, where Amazon is today, you know, if the reference point I would give you is if the Empire State Building was the market that Amazon can target, Amazon today is on the 3rd floor, despite of the rapid growth over the last 25 years. So what you're going to end up seeing is that Amazon will, with geographic expansion of Prime, with increasing e-commerce penetration and video strategy that they have, they will conquer a bigger portion of this pie, and the $1 trillion number on a gross sales basis, not the net revenue basis, seems very realistic if you actually look at the growth of the end markets that they are participating in.
The 3rd floor of the Empire State Building, Michael, would you agree with that?
I think that they can go even higher than that. And I think there's some reasons. I mean, one of them is it's not just about the merchandise they're selling. A big piece of this is some of the other businesses. Their Amazon Web Services, which will continue to grow with the internet. They are going to be the one company that will challenge Google and Facebook in advertising. They have almost as many visitors in the United States as those two other companies. And then we look at it, we have 60, Amazon doesn't release the numbers on the number of Prime customers, but there's about roughly 60 million Prime customers. That's half of the US households. And nobody's even looking at the fact that they're likely to be able to raise prices on those customers. And so there's so many tailwinds in terms of growth for this company that you couldn't be more excited about it.
Jitendra, what do you think the biggest opportunities are?
So if you actually look at what Jeff Bezos said in an interview a couple of months ago, he was asked what could be the 4th pillar for Amazon. He said it could be Alexa or video, or Amazon Studios. And we think video could be a very pivotal strategy for Amazon over here, because today Amazon makes 90% of their revenues only from 5 countries. And Prime is available in 16 countries, but Prime Video is available in 200 countries. So what they want to do is use video, original content, to bring in Prime members, to increase engagement on the platform, get into the advertising business as well, and probably down the line get into content-based e-commerce.
Hang on, though. The head of Amazon Studios left after sexual harassment allegations. They haven't had a huge hit this past year. You know, the main actor in Transparent is gone. Where do you think these hits are going to come from?
Well, they're hoping the new deals that they signed up, for example, the Lord of the Rings series that's coming up, and some regional deals that they signed up in India and Asia as well. You know, they're hoping that that could sort of bring in the audiences. But if you actually look at consumer surveys of why people are signing up for Amazon Prime, the #1 reason is free shipping, but #2 is video, and it's becoming an increasingly important reason.
Do you think video is as big an opportunity?
I'm not sure. I think they're spending a lot of money. They've got some shows, just like Netflix, they're really blowing a ton of money on this. I'm actually more as.
But Netflix has had more success.
Netflix has had a lot more success, but there's other parts of Amazon that people are ignoring, or at least not remembering. Twitch is a massive video platform. People forget Twitch has tremendous amount of traffic and has been way underexploited. But video may be nothing more than a retention vehicle to get people to spend more time with the site and more with Prime. And our Activate forecast for 2018, actually, we believe that speaker sales are going to peak next year because you're going to have Alexa built into every other device. So it's likely, even though they're going to sell speakers, the price on those speakers is coming way down.
So, Jitendra, what do you think the main weaknesses are? with Amazon?
From a threats perspective, regulation ranks the list over here. Within regulation, antitrust topics keep on coming, but the bigger issue here is because third-party sellers, business is becoming bigger and bigger for Amazon, the tax collection issue, that could be a problem. And then, of course, you have competition from Walmart that could delay their grocery plans or expansion in those verticals. So competition and regulation are the top threats. All right.
We'll have to leave it there. Jitendra Rawal of Bloomberg Intelligence. Always great to have you on the show. Michael Wolf, you're sticking with me.
Great to be here.
All right, Microsoft is letting employees who say they've been victims of sexual harassment and gender bias have their day in court. The Seattle-based tech giant is ending its policy that such cases have to instead go to arbitration. In 2015, 3 female employees brought a lawsuit accusing Microsoft of gender discrimination, seeking class action status. Microsoft has also endorsed a bipartisan Senate bill to prevent companies from forcing employees to settle these kinds of cases behind closed doors. Coming up, the battle for music streaming supremacy in China. Just how singing with your favorite stars fits in. This is Bloomberg. YouTube has taken a big step towards its own paid music service. Google's streaming site signed a new long-term agreement with Universal Music and Sony. The deal establishes royalty rates between YouTube and copyright holders for professional music videos. Warner Music signed a deal with the site in May. Record labels have long criticized YouTube, claiming a lax approach to protecting copyrighted content and insufficient compensation for artists. YouTube is promising stronger policing of copyrighted songs. Meantime, the crown jewel in music streaming might well be China, where Tencent is currently king. Tencent Music currently dwarfs both Apple and Spotify in China and is said to be eyeing a $1 billion IPO next year. One music company that Tencent is backing is Smule, whose flagship app, Sing Karaoke, lets users duet with their favorite Disney characters, as well as real musicians. Joining us now, someone intimately familiar with both music and Smule. He holds 27 patents in the field of computer music and email security and is a classical pianist, the CEO and co-founder of Smule. Jeffrey Smith, Michael Wolf of Activate, still with me. So talk to me about this Tencent investment in your company, what you get for them, and you know, does that give you a window into the Chinese music market, essentially?
We're thrilled to have Tencent as a partner. By the way, thank you for having me on your show today.
Thank you for joining us.
Tencent is prescient, we think, understanding not only social media, but the role of media and content in driving deeper user engagement. And I think because of the insight of both media and social engagement, it was natural for them to partner with Smule, because we are a market leader in truly defining a new category in social music, allowing people to create music together on their mobile phones rather than simply passively listen to it.
Michael, give us some context on the size of Tencent Music and the potential of music in the China market.
So Tencent now controls, after a couple of acquisitions, they now control 75% of the music market in China. And they are saying that they're getting more paid subscribers than Spotify. The difference, though, is that they're getting about $1 a month and Spotify is getting $9.99 a month. But there's a lot to suggest that not only are they going to continue to be strong and this is going to be a great business, but it's also going to be focused not just on U.S. and international artists, but a lot of Chinese artists.
So, Jeff, what do you think of the potential for Tencent Music to go public next year?
I think music's gone from the dog to one of the most exciting market opportunities, and I think investors are slowly waking up to it, perhaps in part because we're seeing these innovative business models alongside a recognition that music is one of the most engaging platforms, media, on the internet. In fact, if you look at data from Nielsen, the average American, or even over 90% of Americans, were listening to over 32 hours of music each week. That's up from 26 hours a week a year before. So when you think about how engaging this medium is, and when you recognize that streaming today only represents 6% of music revenue, there's an incredible opportunity for all of us to scale and innovate alongside that engagement.
Michael, Tencent Music and Spotify have an interesting stake swap going on, and yet they are also, to a certain extent, competitors. What do you think of the potential of Spotify and Apple versus Tencent Music?
Yeah, I mean, certainly Tencent is going to dominate in China.
But what about beyond, as we were talking about earlier?
Beyond China, we're really at a point where it's a race between two players. It's going to be Spotify and Apple Music. The one wild card, and people can chuckle about this, is what happens to SoundCloud, because SoundCloud has so much more repertory, so many more songs than Apple and Spotify, which have roughly, between the two of them, roughly 30 million songs.
Right. But it's all the songs, I mean, they would say all the songs you'd want to listen to.
Right. Well, it may not necessarily be all the songs that people are listening to, because actually YouTube is the largest music player. They may not be the ones charging, but more people are listening to music on YouTube than they are in either of the other two services.
That's interesting, Jeff. Who do you think has the ultimate edge?
I think we do.
Shocker. Why?
No, well, look, Spotify has a fantastic business, and Tencent, as you point out, understands the impact of engaging music in China. But if you think of where music is today and where it might be going, say, 10 years from now in the future, or even historically where music's been, it's not simply passive listening and streaming. Music intrinsically is about engaging. In fact, if you look at the segment of the music market today, the biggest revenue producer is live, not streaming. And so if you're truly trying to bring music back to its roots as more of a participatory medium, then it's not just streaming premium content. It's also allowing people to participate, create, explore. So there's a user-generated content segment to this in social media. Smul's building a social network around music.
Let's talk about your deal with Disney. I need to know this for my kids. How does this work? How big is this going to be?
It's really fun. I have a 9-year-old girl who wanted to sing a duet with Maui, the demigod from Moana. And so there she is in her PJs belting out the song in the morning.
There she
is. She was embarrassed that she was in her PJs. I told her most people wouldn't recognize that those were the PJs. But it was so much fun for her to create that experience, to have more of an intimate relationship with the characters. And I guess this was why I'm at Smule and why we believe that there's an opportunity to allow people to engage more with music rather than simply stream and listen to it. This is one example of that.
Jeff, do you think you've got a lot of other companies you can license their music and continue to grow this business?
I do. If you look at the roster of Billboard artists who are creating original versions of songs on Smule, it's not a small list. Ed Sheeran, Luis Fonsi, Demi Lovato, Charlie Puth. And I think what these artists are realizing is that it's a nice complement to the professional streaming to have a social network for music where you can engage more intimately, more directly with your fans. And when we're doing both of these, streaming and engaging, the market itself actually gets bigger. And that's one of the reasons why we're partnering with Tencent, we're partnering with Apple, where with Apple, we'll launch the original version alongside the professional version on our networks, and then we'll cross-promote, and then we'll see even bigger engagement with that artist across the networks.
All right, I am setting a date for a duet with Maui, the demigod. Jeff Smith, CEO of Smule, thanks so much for stopping by.
Thanks for having us.
Michael Wolf of Activate, always great to have you here on the show. My guest host for the hour.
Thank you.
Coming up, we are looking back on some of our best conversations in 2017. We'll hear from former SoftBank president Nikesh Arora on why we're only in the early stages of artificial intelligence. This is Bloomberg. SoftBank's massive vision fund is adding a fintech startup to its portfolio. SoftBank is betting that technology can overhaul the home insurance industry by leading a $120 million round in New York-based Lemonade. The company uses artificial intelligence and bots to minimize paperwork and speed up the claims process for renters and homeowners. And as we wind down 2017, we are taking a look back on some of the biggest interviews of the year. We sat down with former SoftBank president Nikesh Arora on Bloomberg Studio 1.0 back in August. I started by asking about the current state of artificial intelligence and who's ahead in this competitive landscape.
I think the AI conversation is as clear as mud. I think we're in early days of AI. A lot of areas where you want to apply AI, we don't have good data. So it's going to be garbage in, garbage out. The technical horsepower exists, but to apply it, we need to start really getting smart about collecting data and being able to utilize it. So I don't think anybody is ahead.
Do you think Elon Musk's doomsday scenario is overblown or irresponsible, as Mark Zuckerberg says?
I love Elon. I think he's one of the most interesting tech visionaries we have amongst us. And I think we need people like him to make us have these conversations. But I think he might be a little early on his prediction.
What about self-driving cars, which Tesla is working on, Google, Apple? What happens there?
I'm in the camp which thinks it'll be a while before we see a large proliferation of self-driving cars around us. I think the economics, the regulation, the retooling required to get this to happen in scale is far, far, far away. And I think we haven't even thought about the ownership models and the societal problems that it's going to cause, and how do you park these cars? Where do you put them? We may see people who can do closed-loop tests and show you that thing's going to work. That could happen in short order. But I think large-scale deployment and having an impact on the rental business or the ride-hailing business, I think is still further away than we think.
Should Uber and Lyft and Didi and Google and Apple, should all these companies be working on self-driving cars, or should they?
I think different answers for different companies.
Okay.
I don't think the ride-hailing businesses should be worrying about making their own self-driving cars at this point in time in life.
Why not?
I think it's early. I think the ride-hailing industry hasn't settled down. We haven't quite figured out where that industry is going to stabilize. I think they have lots and lots of work to do in the logistics, in the way they move cars from one place to the other, in managing supply and demand, and they're very early in their evolution. So I think if they focused on creating operational excellence in their current business, they might be better off. And there's lots of OEMs, there's lots of tech companies working on self-driving cars. I think a partnership approach might be better than trying to do it themselves.
I know you spent a lot of time thinking about the ride-hailing business. When you were at SoftBank, you put a massive bet on Didi Chuxing.
You know, both Masa and I had long conversations about ride-hailing, and we were very impressed by the Uber model. But at that point in time, we felt SoftBank would be better served investing in some of the other players. So we invested in Ola in India very early. We invested in Grab Taxi very early in Southeast Asia. And we also partnered with Alibaba and Tencent and invested in Didi. And I think subsequently, since I've left SoftBank, Masa has doubled down on many of those bets. So look, I think when you can find an industry where you feel that somebody has developed a product or service from which there is no going back, so it's here to stay, it's a great place to be. It's like when things go from a nice to have to a must have in your life, you realize this is a winning scenario. And you understand that this is going to get more and more popular over time. So I think it's clear in China that Didi is kind of the only player. So I think you can see where if they keep executing well, this is a huge opportunity for them. This also plays into the needs of the country, where you don't want to have car ownership, you want more green cars, and it's much easier to take large players like Didi and get them to work with the government on getting the green stuff,
so
and the electric cars.
Uber has pulled out of China, Uber has pulled out of Russia. Do you see them making those same decisions in India, in Southeast Asia, in Brazil?
I actually believe it's possible for two players to coexist in a market and coexist happily. But I think that requires the markets to rationalize and stabilize. There are many industries where there are multiple players that coexist. You know, telecom services. There are 4 players in the United States. They're competing every day, but some of them actually make large amounts of money. Look at the cable industry, and I think this is a very large market. So yes, can they do deals in those markets? I'm sure they can. Can they go it alone? I think they probably could.
Do you see that with Uber and Lyft here in the U.S., that this is a 2-company market?
As of now, it is.
Does that continue?
It's hard to tell, but I think it will continue for some time. But as you know, there's so many different conversations and moves going on in the market that it's hard to call where it's going to settle down and stabilize.
Part of my conversation there with former SoftBank President Nikesh Arora. And that does it for today's show. Thank you for watching. We will be back tomorrow. This is Bloomberg.